Hey, good morning once again, options traders. And I wanted to post a little bit of a follow-on video from the last one that I did, and I'm calling this one, Each Trade Stands Alone. And that's because I used that phrase in the last video. What I mean by this is that whenever you are placing, let's call it a new trade or a morph or a roll or a hedge, it's easy to get lost in thinking that somehow it has magically transformed that original position into something new. And it hasn't. It's just another trade. Each trade stands alone. Now, as I mentioned in the last video, just because some of those trades will cancel, that's what causes the misperception or the illusion. And this is a super important concept for traders who think that they can dodge time decay or repair a trade. It can really give you bad misperceptions. So let's go take a closer look at why each trade stands alone. As always, before we get started, please be sure to click like and subscribe. It is greatly appreciated and helps so much to promote the channel. So remember that each trade stands alone. And I showed this slide in the last one, and the point is that opening or closing positions just overlay a new position on the current one. This is really the whole point of this video. You're just tacking on a new position on top of the old one. But again, just because some of those happen to cancel out gives the illusion that you're really creating something new. You're not managing your way from a losing trade. You're not dodging time decay, all of these other things that people think. What you're doing is entering a new trade to hopefully reduce the loss of the original trade. So as a simple example, let's say that you have the 100-105 vertical spread. So as always, we've got our bend right here at 100. We've got another bend at the short 105 strike. Let's say that maybe we paid $2 and we can make a maximum of 3. But now the stock has made an even bigger move than anticipated. We sold off all of our rights at 105 because we thought for some reason the stock really had a low chance of getting there. Well, now we're not even at expiration and it's already through our short strike. So what's one thing we could do? Well, a simple morph would be to buy back the 105 call. That's this one right here. And then maybe sell the 110. And that's going to give us long the 100, short the 110. So look at what happens. Here was the original trade. We bought the 100 call, sold the 105. And then the new trade is to buy the 105, sell the 110. And yes, the OCC is going to cancel those. And this is what gives the illusion that we've somehow have morphed this. And yes, in the business, we would call this a morph. But you have to be very careful and realize that all you've done is bought the 105-110 vertical. We don't do this morph just because, hey, I can do a morph. We do it because it was a good opportunity to buy the 105-110. If you wouldn't have purchased the 105-110 on its own, there's no reason in the world to roll this one out. So once we place this trade right here, buying the 105, selling the 110, we extend the difference between these strikes. But now let's say that maybe we have a total cost of 5. I spent 2 initially. Maybe I had to pay 3 for this purchase of the 105-110. So I've spent 2, then I spent another 3. Now I've got 5 into the position for a 10-point spread. So now I've legged into a position that costs 5 that can make 5. So yes, did I extend this upper end? Of course. But it comes at a cost. I could now lose 5, whereas before I could only lose 3. All I've done is I've put on a new trade. So again, when you look at these independently, it helps to think of them as not canceling. So you can think that you had this position in your account, long the 100-105, and then you did a different trade. You bought the 105-110, and you would have 2 different vertical spreads sitting in your account. The fact that the OCC comes in and cancels these is really irrelevant. You have 2 vertical spreads. Now I've got a good trader friend who actually calls, in this case, this initial vertical a phantom vertical. In other words, it's still there in your account mathematically, even though we no longer see it. And that's a really good way to think about what's happening. You're just tacking on a second trade. So before we do this, we have to say, is this one worth it? Not, hey, I can morph it and I can extend my profit range. We always have to ask, is it a good idea to buy the 105-110? So let's now take a look at a more complicated example where traders try to dodge time decay. Here are some prices from a pricing model, 30 days out. But let's say that trader A buys the option for $2.29, and he's just going to hold it for 30 days all the way to expiration down here, and we're going to assume that the stock price doesn't move. Now, yes, that's a very unrealistic assumption, but if we don't hold some things constant, it gets really difficult to follow what's moving. So through this entire exercise, we're going to assume the stock price never moves. Well, yes, trader A loses the full $2.29. Now, trader B, on the other hand, also buys the option for $2.29, but when he gets down to the halfway point, he says, you know what? I can sell my option for $1.62. See, that's what the pricing model is saying it's worth on day 15. It's worth $1.62. So he says, well, why don't I sell my option, collect $1.62, and I'll rebuy the next 30-day option for $2.29, and so that's a net debit of 67 cents. So I can roll this position out and avoid all of this time decay. So now he's got $2.96 into the position. He spent $2.29, he rolls for 67 cents. We get to expiration, and he can presumably sell this option for $1.62. So he collects his $1.62, and he has therefore lost $1.34. That's $2.96 that he had into it, collects $1.62. He's got $1.34 he spent. So now he looks at himself compared to trader A, or maybe compared to himself had he not rolled this, and he says, look, I would have lost $2.29, but because I did this roll, I've only lost $1.34. I've dodged time decay. I'm better off by 95 cents. Well, it looks that way, but that's because you're allowing things to cancel. Let's dive a little deeper and say, where did this 95 cents come from? So to find the answer, let's cut back in here to the roll. This is where the answer lies. Notice that when you bought this option for $2.29, bought a new one up here, and you collected $1.62 for your old one, that was a net 67 cents debit. That's a calendar spread. That's all you did is you bought a calendar spread on top of the original option. Now, yes, again, it just so happens that the OCC is going to cancel this. It's going to say you had this option, you now sold it, and you've purchased a new one. But again, don't let that fool you. You bought an option, and then you bought a calendar spread. And so here's what happened. Here's where the 95 cents is coming from. Here's our time decay curve. And so the option's trading for $2.29, and traders are often fearful of this accelerated path over here on the far right. So they know that they're going to lose money. After 15 days, the option's worth $1.62. And they're thinking, hey, I don't want to go off this steep part of the time decay curve, so let me roll it. And this is where the 67 cent debit comes in. They can sell this one for $1.62 and buy a new one for $2.29. That's the 67 cent debit. And they've now repositioned themselves up here. So what's really going on here? Well, when you first purchased the calendar, you paid $2.29 and you sold this one off for $1.62. There's your 67 cent debit, or the amount that you rolled. However, when we get to expiration, yes, the one that you sold goes to zero, because we're assuming the stock price stays the same, you don't have to buy it back. So yes, we collected $1.62, we pay nothing to get it back, and so that gives us $1.62. However, we also lost 67 cents on our new long position. Remember, we paid $2.29, 15 days later we can collect $1.62. So $1.62 minus 67 cents, what's the net between these two arrows? Right there, exactly 95 cents. So yeah, it looks like you have a profit of 95 cents that we're comparing to trader A and saying that therefore you've dodged time decay. You didn't. You just bought a calendar spread that happened to work out. Now we can also see more of where these numbers are coming from. If we take the 95 cent profit divided by the 67 cent cost is $1.41, and we've talked about the square root pricing rule before. $1.41 squared is 2. What that's telling you is that the option you purchased had twice as much time. That's where these numbers are coming from. But you can see it can get very easy to get lost into these numbers and think that you've somehow magically transformed this into a way to dodge time decay. all you did is you bought a calendar spread. You bought the 30-day and sold the 15-day. And so yes, you've got the potential for a 95-cent maximum gain if the stock stays right here at 100, but if not, you're going to be worse off by 67 cents compared to the trader who didn't do the roll. Everything is a trade-off in risk and reward, and if you're not seeing the fact that each trade stands alone, you're going to make a lot of bad decisions because of the misperceptions. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.